Are you thinking about investing in Disney? Or maybe you're one of my copy traders and already have a position and want to know why I have it as one of my handful of companies to invest in. Well, in this video, I'm going to break down some of the reasons why I think Disney will be worth around double what it's worth now in 6 to 12 months. Stay tuned to find out. Hello and welcome. I'm Wayne from WES Investments, bringing you stock market news, portfolio updates and training on how to make money in the market, all on this channel. So if you're new here, consider subscribing and hitting the bell so you're notified of all my new videos. The boring bits first, this is not financial advice, I'm not a financial professional, everyone's financial situation is different and you should not consider this or any video you find on YouTube as financial advice. Now, Disney is a huge company, and I think to just make one short video to explain the investment case for Disney would be like trying to sum up the Lord of the Rings in one sentence. Just don't do it, okay? So what I'm going to do is break it down into 4 segments, and these are the ones that have been created by the business, and I'm going to do a video on each one of them. And this is part 2, media networks, and if you haven't seen the parks and experiences segment, it's right here. Now, the media network segment of the business includes the cable networks and the broadcast networks created for the USA only. Okay, all of the international, all of the Disney Plus, all goes into a separate segment. Okay, and that's not going to be covered in this video. These channels are actually generally been performing very badly. This should mean, in theory, that profits can be maximised by moving these channels over to the direct-to-consumer model, rather than being forced through third-party partnerships. Now, obviously, this is an international example because I'm in the UK, so I don't really know the different packages in the US, but imagine that I'm talking about this from a US perspective. So, with the UK, you can get Disney Channel with Sky TV, which is £25 to £30 a month payment. So if you're only actually interested in the Disney Channel, or that's the main kind of focus, you have to pay £25 to £30. However, this has now been cancelled and you can just pay £5 and get it direct with Disney Plus. And that is far more accessible. And that's why a lot of people are downgrading their TV subscriptions and they're moving over to this direct-to-consumer model. So for Disney going forward, we're probably going to see quite a lot of the moving down on the media network segment and moving up on the direct-to-consumer and international segment. However, this does not appear to be impacting the US networks, and the channels are still available there. It's only actually happening in the UK and internationally that these channels are disappearing. So, but the point is still that the fact that these customers are going to move away from this TV subscription model and move towards the direct-to-consumer model. So the income generated from this segment comes from affiliate fees, advertising and distribution. So to break that down a little bit, the affiliate fees, this is what multi-channel video programming distributors, which is MVPD, such as AT&T and Comcast, pay per subscriber to carry channels owned by Disney. And in 2019, this accounted for $13.4 billion. The advertising segment, this is income generated from adverts on the various channels owned by Disney, and this accounted for $6.9 billion. And then we have distribution, and this includes TV licensing and subscription video on demand, SVOD. This does not include online content such as Disney Plus, as I've said earlier, and in 2019 this accounted for $4 billion. So if you're not quite sure what that really kind of covers, it's if you've got a TV channel that decides they want to play a Disney film or something, they will pay Disney for the rights there. That's the TV licensing. And the subscription video on demand, that is for pay-per-view films. So for example, you might be in a hotel and select a Disney film from there, or obviously various different network providers also allow you to do that. So that's that part. So here's a bar chart with the operating income for the media segment over the past 10 years. This segment appears to be quite steady despite the rise in streaming services like Netflix, taking customers from the traditional TV networks. In many respects, you would expect to see a decline over the past few years as customers leave traditional TV behind to move digital. And later in the video, I'll go over that even more. But the bar chart here shows a consistent around $7.5 billion in operating income each year. These results also include the consolidated 21st Century Fox. So as you can see there, in 2010, we started off on about 5 billion, and it's slowly sort of climbed a little bit, and then it's managed to stay quite flat. So now I'm going to show you a bar chart that's showing a very different picture. And as you can see, these results are what you would expect to see when you consider the dropping annual subscriber numbers. So as you can see here, from financial year 2013 onwards, the subscriber numbers have dropped consistently every year. Now, the reason that the dropping subscriber numbers has not impacted the bottom line is because as the numbers have dropped, the amount each subscriber pays, on average, has increased. This is caused by a number of different factors, including price increases, as well as customers consuming more services. When you consider that over the past 10 years, Disney has purchased and created considerable content and channels, you would expect the spend per customer to grow. This is why the next graph is also important. The operating margins were higher in 2012 and 2014 than they were over the following years, and 2019 being the worst year since 2010. Disney had a consistent operating income over the past 10 years, despite dropping subscribers, and they've done that by increasing its revenue significantly. This has not been the most efficient when considering direct income numbers. However, the ownership of that content will provide multiple benefits over the coming years. So problems that we've got for this segment going forward. We've got falling subscriber numbers. The numbers leaving TV subscription services are growing at a constant pace. This would mean big drops much sooner. This is not just a cost thing for customers, but also ease. With the shift towards digital content and smart TVs, it's becoming more cost effective to just pay for the content that you want to watch. Most TV packages are very general, and having content for everyone, with digital subscription services you can select your own content provider, makes it a lot easier. Even picking up and dropping services that you no longer require throughout the year, rather than being locked into a long-term contract. We also have quite an issue with the sports decline. Now, historically, sports have been very popular. This huge increase in demand has pushed sports personalities' wages up to phenomenal levels, which in turn makes sports events very expensive. This high cost of the events are perfectly fine when there is huge demand, and as they're still very popular. However, modern generations are far less interested in sports. This cultural change has not hugely impacted the industry yet. However, going forward, I believe demand for sports events will start to decline at a much higher rate. If sports players' wages do not start to decline at the same rate, then there is a good chance that sports teams will start to go bust. The level of these commitments can be seen by the fact that Disney's sports programming commitments were a total of $44 billion at the end of 2019. We also have falling advertising revenue. Although this is not actually strictly true, TV advertising spend is actually increasing year on year. And this is shown in the year-on-year increases in advertising revenue shown in Disney's accounts. However, looking at the wider market, you can see that the focused advertising is far more effective way to advertise, and with falling TV subscriber numbers, there will be a point when TV advertising peaks. I believe that this will happen very soon, and it has already impacted a number of other TV providers worldwide. Now, in the upside for this segment, the global pandemic will cause sports events to either be very limited with people being able to attend the events or people being concerned about attending them. This will force customers who wish to watch these events to subscribe to TV channels or pay for the individual events. The pandemic has also pushed people inside to watch more TV. This should increase revenue from the various different elements and should also increase subscriptions after the pandemic ends due to people being entered into contracts. More of a focus on live TV can help to ensure efficient and focused spending. By that I mean that due to streaming services, much of the TV shows do not need to be seen live. They do not need to be seen on TV. However, when you consider sporting events or news, the benefit of using streaming services are just not as prominent. This means that viewers that are interested in live events and information will continue to use over-the-air TV. Focused investments in these areas can mean maximum return on investment. Now, as you can tell, Disney owns a lot of stuff, and again, this is just one segment. Thanks for watching. I hope you've enjoyed this video and found it helpful. If you have, please give me a thumbs up. Make sure to catch my next video, which will be studio entertainment, and I will see you there.